About Bank 5 for you, and we'll start up right off with our mission statement, which is we're a community bank focused to create an above-average return for shareholders within 5 years by emphasizing a positive community impact through high-quality customer service while providing positive personal and professional opportunities for our employees. So notice we're focusing on a 5-year outcome. So basically we're in it for the long haul. We are patterning ourselves after a bank that we saw that looked very interesting to us called Granite Community Bank in Minnesota. It's a diversified community bank, diversified in that it does not only traditional banking services to business and individuals, but also it offers loan and insurance and financial services, as well as the traditional banking services. They're a little bit riskier in some ways in their approach. They have a relatively high loan to asset ratio of about 96%. So maybe because they feel they have some non-interest income, they feel they can go a little bit riskier in their lending policy. So that's a little bit on our strategy. Let's talk about some of our financial objectives on a quarterly basis here, but for the annual share price growth, we think we're going to be in at 5%. We think that's a reasonable annual growth rate because we're hoping for an EPS growth rate also of about 5%. We're in the banking business. We're not a super growth-oriented company. So if we get 5% in our first go-around, we're happy. Our dividend policy is relatively close to industry average. About 25% of our 80 cents a share earnings is going to be paid out in dividend. So we're going to have a 20-cent dividend, so 60 cents per share will be added to retained earnings. So, we have a AAA bond rating already, and we want to maintain that. A step to doing so is to put most of our earnings back into the bank as an increase in our equity capital, which we do so with that dividend policy. And our return on assets, we're starting out with what was given to us in the simulation. We have a beginning ROA at 0.0297 as we calculated it. Therefore, that's quite low. So we're just saying our goal is to get it up to 0.04. Normal ROAE is about 0.11 for a bank, so we're starting out quite on the low side here, given in the simulation, but we want to bump it up. Our ROA was given at, we calculated 0.004. Again, less than half of industry average, so we're just going to say we're going to move it up to 0.01, which is a significant increase, but that's the significant digit limitations of the software involved there. Our total assets, we would like to grow between 1.5% and 2%. Industry average is about 1, so we want to grow a little bit faster than average. Our total loan growth, we say 9 to 12. Industry average about 9, so again, we'd like to grow faster than average. Our efficiency ratio, given what is in the simulation and our calculations, comes in at 0.139 and or 13.9%, and that's incredibly good. And, we figure that maybe reasonable for the future would be in the 14 to 15% range. Our pricing strategy, we're basically, at least at this initial stage, we're going to be at about parity. As a community bank, we don't think we're going to have access to the high rollers of this world, so we probably think parity is about the best approach at this point. In terms of our capital adequacy ratio objectives, capital adequacy ratio, of course, is equity plus your secondary loans over total assets. Our current CAR is at about 15.9%, and essentially with some of the other things that we're going to do, we feel that we don't have any, we have zero secondary loans, where the bank goes in the credit market and issues its bonds. We feel we can add to our secondary capital by about 60,000 at least in the number scheme of the simulation. That may be 60 million, I don't know. But we're gonna add secondary loans, 60,000 up from zero, so that's gonna mean that we'll have a target CAR objective in the 16 to 17% level. Our Tier 1 and CET1 objectives, that's really our equity. Essentially looks like in this situation, it's our equity over asset ratio, and we feel like a 14 to 15% ratio, kind of close to where we're at now, is a sensible approach. Our liquidity risk numbers, we calculated our liquidity risk ratio, that is interest-bearing assets over interest-bearing liabilities. We have, it's at 1.116, and looking at some of the numbers there, we're going to, for like liquidity coverage ratio, we say minimum 110, maximum 130. So we want to stay kind of in the conservative range here for these liquidity ratios. In general, liquidity and banking, if a bank has too low a liquidity, then that's going to dampen profits because of increased risk. If it has too high a liquidity, then that means that it's has too much low or non-interest bearing assets, and that's going to dampen profitability. So it has that kind of curvilinear relationship, and we're going to try to stay sort of in the middle there. Maybe increase our liquidity risk a little bit, but not too much. In terms of the interest rate risk, we're just looking at the current interest rate environment as we understand it. Over the last year, we've seen in the U.S. Initially a rise in the interest rate with the U.S. T-note 10-year bonds priced from about 128 going down to about 118. Recently, those government bonds have risen in price, indicating some sentiment that maybe the Fed isn't going to tighten as much, perhaps due to recognition that inflation levels are low in this country. So in other words, we've had a movement in both directions within the last year in the interest rate environment. So therefore, we think in this uncertain environment, we're just going to put our interest rate minimum as -10 and maximum +10. I hope that operationalizes essentially uncertainty anticipated in the interest rate environment. Anyhow, thank you very much for this opportunity to plan the strategy for Bank 5. See you next time.